everyone. I'm looking forward to being here today and jumping in on this. So, as she mentioned, we're doing a lot on wildfire recovery ever since last January's wildfires. And when we started talking about like what it would be helpful to talk on today, I wanted to highlight one particular piece of that. But before I get into that, I want to zoom back in really to last January and where we found ourselves. Sorry, I got like a bunch of, I'm holding this in my hand. I got a mic here. I got a hitting. So if I drop anything, just give me a second. Last January, the wildfires like hit LA, obviously, as all of you know. And one of the silver linings, I would say, of all of that is watching people really from all over the world come together and unite, both on the ground, like in real time, and the stories of folks like pulling up from driving from all over Southern California to help out, but also opening up their pocketbook. And we saw like over $1 billion raised in philanthropy during that period of time. Just at the Community Foundation alone, we had over $100 million raised in the 60 days following the fires. And so what we did really initially with that was we got to work, right, with humanitarian response to the need that was on the ground, and gave out a bunch of money, $30 million in the first 30 days after that, really helping people with basic shelter, food, you name it. Well, we didn't give it all out. And part of the thought really from the very beginning was looking back and understanding what the horizon of recovery looks like, and knowing that to build back at the scale of loss that happened, both in Malibu, the Palisades, and Altadena, was a 7 to 10 year, if not longer, horizon. And so we held back a lot of those funds and started asking the question, how do we start thinking about what the future is going to require and the role that philanthropy can play in that? And a big piece of this work was founding in partnership with Evan Spiegel and Snap Inc., something called Department of Angels. And so this happened really within just days after the fires. We got together with Evan and created something really with the goal of centering survivor voice. We wanted to know what was happening on the ground for two main reasons, right? One, on the philanthropic side, to know how to direct and target philanthropic resources. With $100 million is both a lot of money and nothing at all when you're talking at the scale of recovery, the billions of dollars of change that's going to be required. And so with that $100 million, how do we target that in a way that helps those the most? The second piece of it really was asking the question of what are the type of policy reforms and advocacy that we need to make, and how do we understand survivor voices in order to do that? And so Department of Angels launched a quarterly survey. We've now done 5 of them. The most recent one came out in March of this past year, or in March of 26. And that has become the only statistically significant survey data that we have of survivors. It was where we originally learned that insurance companies were having like structural issues paying, and there was a real unevenness across different insurance companies. That's now been taken up both by the mayor, the president has mentioned it, and the governor has instituted investigations with certain insurance companies. That largely came as a result of us being able to show statistically significant data that this, in fact, was an issue. It wasn't just anecdotal. We also saw similar issues around soil contamination and smoke contamination that was not cleaned up in the immediate days after the fires. And so it's been a really helpful, all that to say, it's been a very helpful tool for us to understand what the needs on the ground look like, and is it scale or is it just anecdotal and one-off scenarios? So I say all that to say, one of the key pieces that came up over the course of the last few surveys, and started showing up last July and has continued to mount, is an issue around access to capital. So I mentioned insurance companies. Insurance settlements and payouts have been uneven. Some insurance companies have already cleared the slate and paid out. Others are slower. And on top of that, a lot of insurance providers have programs for what's called loss of use funding. So if you lose your house or in a fire or earthquake or what have you, that there's a period of time where they'll cover that. That's beginning to run out for families as well. And so we're seeing over and over, and you can see here on the screen, a $500,000 to $600,000 gap in access to capital. And so we started asking the question, okay, like that number has continued to climb over the last couple of surveys, but it was showing up early last summer, and we didn't really understand why. And so what we have found within that is that this is something that the cost to rebuild has now become the number one barrier for over 40% of survivors. That 46% of survivors have drained their savings. Many have taken on short-term debt, retired their, exhausted their retirement accounts, et cetera. And the confidence is beginning to erode for wildfire survivors. So on the far side, you see 1 in 5 unsure they'll rebuild. Each quarter, that's getting worse and worse. And this happens oftentimes in recovery. It's happening in an increasing way, and in large part because you have to think about the mounting financial challenge that survivors are dealing with, right? Because they lost their home, now they have a mortgage on a house that no longer exists. Maybe they got deferral, maybe that's ended, that's up in the air, it changes, it's a bit of an uneven process, but you still have the mortgage there even if you're not paying monthly for it. And then if your loss of use funding is running out, now you've got rent on your house or your temporary apartment or what have you. Maybe you're fighting with your insurance companies. If you're in Altadena, then you're fighting with Edison on whether you're going to get settlement or otherwise. And all at the same time, you're trying to go on with your life and planning for how do I rebuild, and do I get a construction loan to rebuild, and how do I do that? And so you can imagine that this is not just a challenge for the lowest income survivors, but really a challenge across income groups. And with the very few exceptions of high liquidity individuals who have a ton of cash on hand, almost everyone's facing major issues with the ability to rebuild. The problem that we discover that led to the $500,000 to $600,000 gap is that many of the survivors are having a hard time accessing traditional mortgages as part of the rebuild. And so what we did as philanthropy, we convene back to the point about really how do we do political advocacy for the types of issues that matter and bring together business and philanthropy and civic leaders to make change. Said, okay, well, why is this $500,000 to $600,000 gap showing up? Why can't I just go, if I'm a survivor, to Bank of America and go get a mortgage to rebuild my home and consolidate my debts and navigate all that? We learned that the banks don't actually offer mortgages like this anymore. So historically in the US, something called a construction to perm mortgage existed. And a construction to perm mortgage, the best way I can describe it is my grandfather. My grandfather in the 1960s got out of the military, bought a lot, and said, I want to build a house. And he went to the bank and he got a mortgage to build the house. And then after the house was built, it converted into a traditional 30-year mortgage that you typically see in the market. That is a very common way across the US historically that many people built that. In 2008, when the housing crash occurred, many banks really got upside down on a lot of these homes. And so in the aftermath of all of that, really receded from that and said, okay, we're only going to offer mortgages on existing homes so that we don't have the risk during the construction period for doing that. Largely, that's not a major issue in the US because the majority of home building in the US is either by major builders like the Lennars of the world that are going to build 100 homes at a time, 500 homes at a time, or for custom-built homes that don't need the same type of traditional mortgage structure. It's a real issue when you have thousands of homes that burn down all at once and thousands of individual homeowners who are looking to rebuild and going to the bank and saying, hey, can I just get a mortgage to consolidate my debt and rebuild my home? And the banks don't have it. So what we did is we brought together the banks, philanthropy, and government and said, how do we solve this problem? We need the banks to be in this space, and we need to be able to provide mortgages. Philanthropy alone, going back to only having $100 million, is not going to solve this problem alone, right? We could issue a handful of mortgages and be done. We've got thousands of homeowners. Government alone is not going to be a mortgage issuer, but historically, across the US, the government has been able to play an important role in reducing risk to private lending in order to move that forward. So we did a couple things. One, we launched an impact fund. We took a tranche of our funding to seed it and are raising additional impact capital and said, hey, we need concessionary capital that can de-risk different types of programs like this and really able to move that forward. And so today we've raised $36 million toward $100 million towards that. And one of the key investments that we made out of that is in partnership with a CDFI called Lindustry. And the way that we've set this up is a construction to perm mortgage that they will offer in place with critically, a 20% silent second in the wildfire fund. And so a silent second mortgage is a common thing that you'll see in the mortgage industry. Oftentimes, you may be familiar with something like a down payment assistance program. It's akin to that. But what it does functionally in order to bring private capital back into the market is that the silent second sits as a second mortgage on the home, but the homeowner does not have to have any current payments on it. They only have to pay it back when there's a liquidity event. So if they refinance their house or sell their home in the future, that's when they pay that portion back. It helps in two main ways, right? So for the homeowner, they don't have to pay for that. They only pay for it in the equity accrual over time. So it allows them to put more debt on their home without having a higher monthly payment. For the bank side, it reduces their risk because now there's a second mortgage that sits in the first loss position. So if there are any losses or lack of appreciation on the home, it's less risky for the banks. So that's what we did. We funded an initial pilot with Lendistry to do that and have raised additional philanthropic capital. And this is still debt that still get paid back, but it sits as a concessionary piece in the way it comes together. And this will launch later this month, or I guess it's not quite June yet. It'll launch in June. The other piece of this that was really important to us is that we knew we needed to get scale, right? Philanthropy was not going to be able to help the thousands of survivors that really needed this type of product. And so together with several key bank leaders in the state, we approached the governor's office and said, hey, look, here is this data we've got from Department of Angels. This is a massive issue. 2 in 5 survivors don't have access to the capital they need. The banks have testified that they are not in this market. Philanthropy alone cannot get the full banking industry back. We can get a couple of banks to play and we can build a pilot and show that this is needed, but we can't really do it at scale. And to their credit, they took that data and they rolled up their sleeves and said, how can we be helpful? And so what we've done over the last 6 months is work really closely with the governor's wildfire recovery team to build the disaster recovery fund. And this is currently working its way. The governor announced it about 10 days ago. And it's working its way through legislature. It'll be voted on by middle of June. So if you have any opportunity to advocate for its passage, but we're optimistic that it will get passed. And so what this is a $100 million fund that does 3 things that are tied to what I'm talking about. One is construction guarantees. I'll come back to that in a second. The second is interest rate buy downs. This is to buy down the interest rate during the construction period, going back to the issue of liquidity that many survivors have that's beneficial. And then a silent second program that would provide additional funding alongside the philanthropic silent second program. But what I want to zoom in on is the construction guarantee, because this here is the thing that I think unlocks private capital and really is how you bring public, philanthropic, and private capital together to do interesting things. The construction guarantee is just for the period of time that the house is under construction, which is the period of time that the private bank said was the riskiest. And so we said, okay, come in and guarantee losses during that period of time. And so that's the way this is designed, that for the 18 months, let's say, that the house is under construction, that there would be a guarantee by the state that if there are any losses incurred, the state would take those losses so that the private capital would not have to. And this is critical because the bank said this is the one risk area that they were not comfortable taking on. So by putting on one side the silent second loan program with philanthropy that says, hey, we'll be in a first loss position, and then having a guarantee on the other side, we've been able to really hug private capital and bring them back into a risky space, right? Not offering construction to perm loans is one thing. Not offering them in disaster recovery areas where growth is uneven and equity appreciation is uneven is another thing. And so what we've really done here, we think is created a box for private capital to come in alongside philanthropic and public investment, really to expedite recovery in a scaled way. For us, helping 25 homes means you're helping 25 homeowners and 25 families get back. But if we don't hit the thousands in our scale, then we failed at the fundamental task of recovery. And so the way these 3 things come together, right, is you've got philanthropy, you got banks and the CDFIs, and you got the state that I've talked about. So on one hand, risk reduction, right? In order to get private capital to move, you got to get the risk profile at a certain level to get them to be willing to invest. So the silent second and the guarantee plays a role on that. Capital provided. You need a combination of concessionary capital and private traditional bank capital in order to move on this. The concessionary capital particularly is critical because many homeowners were underinsured. And so in addition to let's say your home's $600,000 to rebuild. Most of them are more, but let's say it's $600,000 to rebuild. But your insurance company, but you had an $800,000 loan on your last house, and insurance is only paying $600,000 of that back. So you might be upside down, and you have to consolidate that $200,000 that doesn't exist in real value for the bank to underwrite on the new house. And so that's why it's really important for philanthropic concessionary capital to come in the silent second to help smooth out those types of bumps. So then that comes in, and the end product really for us and our end goal is that every survivor, regardless of their income, has a pathway back. And if they want to rebuild, that there are the right types of products available, and that they can go to a bank, and a bank will actually give them a mortgage, and that the right type of support exists around them in order to make that happen. So that's where we're at right now. And this is kind of a high level of what we're working on and moving this. The main thing I'll mention here at the bottom is that what we see this not as a LA disaster recovery effort, but really as a scaled solution that every disaster that happens across the country should have in its back pocket. The next time there's a disaster in California, the disaster rebuilding fund that we worked with the governor's team to build, that'll exist. It'll already be there. It'll be designed to roll into the next one, really with the goal of helping disaster recovery move quickly and helping people who have survived those disasters begin their process of getting back home. We're 18 months since the LA wildfires, and we're just now launching this. Candidly, that's not fast enough, right? And so our goal is that the next time it's ready to go and ready to move. I was just talking with the head of economic development for the city of St. Louis a couple weeks ago, and they had a massive tornado and are having the same issue there, right? And this issue is repeated elsewhere, really throughout the country. And with federal instability around funding sources, it's even more critical for us to come together. And so I think that this is a really interesting example. Traditional P3 deals, you're thinking about real estate development and how are you building a building like this or a new civic center or otherwise. But tools like this, I actually think are another way of thinking about how public, philanthropic, and private capital can come together in really interesting ways. So that's it. That's what I got.
Awesome.
Thanks, Joe. Yeah.
My question is, we are already investing, and not question as you can say, it's a comment on that, because the investment on losses and damages are exceeding because of the extreme weather events. Right? We all agree with that.
Right.
So, because my company, we have introduced a new standard of sustainability to actually make the buildings more sustainable, not just sustainable, but more climate mitigation into the mitigation sector. So I want this, do you think the government can support or advocate for those kind of a standard like LEED and all, they already exist, but they are not delivering on climate mitigation. But our need right now is mitigating the climate, so these disasters could be prevented and they do not occur as often. So do you think government can advocate those kind of work in the building industry?
I think the short answer is, and to repeat the question, was asking about sustainability standards broadly and the role that plays in all of this. A lot of what we're seeing as we're starting to underwrite these mortgages is the insurability question, right? Okay, yeah, you might have had insurance on this home before, but is there an industry or is there a market for that to come back? And there's been a lot of interest on that side and a lot of conversations. We're working with several disaster resiliency related companies that build back that way. And some of the insurance companies are mandating it. And so I think there is a role, like a regulatory role to play, but I also think some of this the market will require as well in order to make it an insurable asset. And you got to be able to get insurance for the banks to give mortgages. So they're obviously all interconnected.
We wanted the standard to be mandatory for building design processes. So what do you recommend? Who should we contact and who is the best resource within the California government sector?
Well, the Department of Insurance at the state is probably the best place to start as far as like regulatory requirements on top of that. Because my sense is that your question is obviously important, like kind of existentially. I think from a regulatory standpoint, the Department of Insurance is the best place to put in certain guardrails for that.
Thank you.
Yeah.
I was just actually at they called it the Insurance Commissioners in Waiting Forum.
Okay.
They had a forum for. And,
sounds invigorating.
They said that I think all of the candidates that they felt were replicable, or reputable, all said that they wanted to, it's more of a WUI standard rather than LEED from a fire standard, WUI and more of the fire home hardening, but they all said that they wanted to move that forward. So we have a new commissioner, they're planning. So I have two questions for you. One, how did you pick the 45 homes for the pilot? And the second was, I was on a call with a measure for California Affordable, that this is a new measure that's going to be on the ballot in November for $25 billion in revenue bonds for middle class, for newly constructed homes with only 3% down. Are you familiar with that? And where does that fit into this financial equation? Is it going to be for those kinds of construction? So the first question is, how did you pick the 45? Or have they already been picked? And then the next question is this new measure that's going to be on November.
So the 45 have not been picked yet, but the standard for this really is focused on those that, well, one thing I should mention is we funded a grant to the Center by Industry, which is their 501c3, to do like credit readiness work, right? So to help survivors boost their credit scores and be maximum eligible for this. So the way we've structured the 45 on this is the 45 is really limited based on the silent second portion, and that's for like targeting those that are 80% median income and below, but we're not making a hard line there. So it will be prioritized as folks come in that are at the lower income threshold, but depending on demand and appetite, there is room to lever that up if there's not as much demand at the lower levels. I mean, we anticipate there will be, but that's the way it's been structured.
So you're working with industry to sort of figure out standards, and then how will you roll that out to the community?
So I mean, we will do like a full launch the second half of June to do so, and the goal is that by the time we launch, if the governor's work passes, we'll already be able to expand the application pool, because we have gotten a lot of feedback from the banks that said, hey, like if that guarantee is in place, it's a lot easier for us. So we started working on the industry pilot and the philanthropic dollars before we knew if the governor's thing was real. We're like, we need to get a pilot out, we need to prove this is real and prove the need for it. So now that is also kind of lining up and coming together, we think that we can expand beyond 45 very quickly.
Okay. And do you know anything about this measure?
So I'm familiar with the measure. I don't know a ton about like where it stands as far as like it's like whether it's going to pass or anything like that. But we are supportive of the new homes piece, and one of the things that we've advocated for in that is that any rebuilt homes qualify under the new built homes, so it would be eligible in disaster areas.
Yeah, I had a question on when you're talking about risk. Are you talking about like how people are actually going to rebuild the homes? Because you're talking about the financial risk and the gaps and things like that, but there's always a high risk of these kind of things happening again. Is that being discussed on how the homes are being rebuilt?
I mean, so it varies in like disaster risk areas. So there's different fire risks depending on where you are, like how far south you are, for instance, in the Eaton fire zone. And so that, I mean, a lot of that, the way a lot of that is working itself out really is through insurance, and because insurance, you have to be able to like prove that you're an insurable product before we can issue a mortgage on it. And so that's the main way that the burn down related risks. The other thing that we have worked on closely is with the Resiliency Company and a few other organizations that do fire hardening and some of the work that you were mentioning, so that we can really maximize whatever the designed rebuild is, like maximize its fire resiliency to make it more insurable. So I mean, that's how we have focused on that, and it's been something that we've included. And there's additional grant funding too from certain nonprofits related to this. So a lot of the work has been around that, but it is really case by case, right? Because different parts of the fire areas have higher or lower risk profiles.
So you're saying grant programs, because I'm in the industry of building.
Okay.
And so that's where I have interest in.
Sure.
How people are rebuilding, people are not rebuilding with wood and things like that.
Right.
So,
I mean, I would say like, and I'm happy to connect you with some of the folks at the resiliency company. They're doing the most I'm aware of around grants, and some of this is, you know, it's exterior finishes, it's, you know, what type of roof are you using, what type of windows, all that type of stuff, and they're providing like rebates and grants to homeowners as they're making these decisions that might be of interest to you.
And SBA and Firewise Council are also offering grants.
Yeah, I'm familiar with the Firewise. Yeah, 'cause a lot of the homeowners I speak with, you know, they want to build in a way that's more resilient.
Sure,
but,
sure,
you know,
yeah.
It always comes with a little bit of a premium.
Right, yeah, 100%.
Yeah, so Josh, thank you so much. And this is a perfect example of the public sector, the private sector, philanthropic sector collaborating.
Yeah.
Really, really cool. Talk just a little bit about both the opportunities and the challenges. You're talking with the state government or with the county government. You're the private philanthropic center or sector, and you have donors. And then, of course, private sector who's trying to build, and private property owners who are trying to get built. Can you just give us some advice about whether we're in the nonprofit sector, the government sector? Give us some advice that you've learned over the years about communicating with government or communicating across these sectors to create these kind of partnerships, because you're obviously have done this really well.
I think the biggest challenge is choosing sometimes. I mean, with a situation like the fires, there's so many challenges. I mean, right before this, you and I were talking about infrastructure issues, right, and how you're dealing with navigating that. And the reality is that we've got a $30 to $40 billion hole that we're waiting for from the federal government. That creates all kinds of challenges on rebuild, like in a completely nonpartisan way. Like, it just creates a challenge that's like, how do you solve that if that's not coming or if that's unpredictable? And so I think, and I think we're seeing that both like locally in our organization, but then broadly is like, what do you focus on? And I think that's the biggest challenge. And sometimes that can be paralyzing. So then you do nothing, or you do a little bit of everything but make no change. And for us, this is why we use the data. I mean, I started there, right? But that's why it was important to us to create a real rigorous data process, so we're not making decisions just because you were the last person to talk to me and you were complaining about insurance, so that's all I'm focused on now. But it's that this really is what the collective challenge that we're facing is. And so that drove the data like an evidence base drove a lot of this. And then it's sitting together and figuring out, okay, here's where the real challenge is. Do we have the pieces to make a difference here? Like, I guess that's the other piece of it, right? And can we collectively do something? And when it came to this access to capital piece, we're like, oh, this is a major part of it. If we don't solve for this, then we don't start rebuilding at the scale that we need to really recover, right? And then you have all the downstream impacts of, okay, the property tax base doesn't recover if you're not building enough homes fast enough, which means you can't pay for the infrastructure, which means you can't, you kind of start running down each of those rabbit trails and you realize this is a fundamental issue. And also, it's an issue that between government and philanthropy, we can probably solve at a decent scale, right? Like, we're not going to be able to solve the FEMA housing mission that's hundreds of millions of dollars to go build temporary homes, like was built in Hawaii after the fires, for instance, right? But we can solve this one. And so to me, it's a little bit of like you're playing a kind of a cross section of like, what's needed most, what can we actually do, and then just do something.
Yeah.
Like, it's really easy to just do nothing and be like, oh, we tried and we gave out, 15 grants and we called it a day. Just do something.